Our question is really a reference to Friends, but the idea is that the Fed's going to have to pivot at some point because of financial stability concerns, and when that may be and what that means for the market. What's your take?
Well, the take at Goldman Sachs would be that the Fed is in the process of tightening financial conditions, and there are a number of components to that. You've been emphasizing the Fed funds rate, which is certainly a decision, but there's also the level of the 10-year bond yield. There is credit spreads. There's the dollar. There are equity prices. All of these are contributors to a measure of financial conditions, and the idea of tightening financial conditions would incline ourselves from a strategy point of view to focus on higher quality stocks, and we can define higher quality companies in the context of stronger balance sheets, less variability in their growth rates, a higher return on equity, a return on capital, less drawdown risk over time. These are some of the attributes that, historically speaking, Alex, have tended to outperform. Companies with these attributes have tended to outperform in environments with tightening financial conditions, which I think characterizes the financial environment that we're in right now.
David, were the Fed to pivot, though, how different would that list look like? What kind of stocks, what kind of assets would you want to own in an environment where the Fed is pivoting?
Well, God, it's a question sort of hypothetical, which is if they were to do so, what are the impetuses? What would prompt the Fed to do such a thing? Well, it might be that the economy has slowed to a certain degree, such that there's concern about tipping in a recession. It's not the baseline view here. In terms of what companies would do better then, well, some of the much more defensive-oriented companies, value in particular, would come to the fore. Thinking about that as an attribute as opposed to growth. On the other hand, if the idea of the Fed's pivoting and rates are falling, that could benefit some on the growth side. So think about it as a balanced portfolio. Mm-hmm. What would be the reasons for it? I think becomes the critical question. And it's to underscore the fact that it is not the view here that the Fed is likely to be pivoting anytime soon, and given their dot plots and the commentary. My colleagues in economics tend to focus on that more than I do, but certainly it's highly relevant to the equity market, no doubt.
Yeah, absolutely. And you guys, taking a look at your view in particular, you have 4,000 on the S&P for next year in a soft landing scenario. You have 3150 in a recession. In the 3150, what's your base? Like, what does the recession then look like, and how do you manage that risk?
Well, to be very clear, let's lay out some of the path for both of these. So in the baseline expectation is that the Fed is able to manage a soft landing. So there's a narrow path to a soft landing. And what would that would involve? The economy slowing, the labor market slowing, and inflation, most importantly, coming down. And to the extent that that happens, the economy continues to grow. And that would basically be consistent with some of the higher quality stocks continuing to do better. And that would sort of be the baseline forecast. And Alex, you want to think about the level of the S&P 500 at the end of this year, somewhere around 3,600. That would be the building blocks behind a story of around 8% earnings growth this year, decelerating to around 3% earnings growth in 2023. And the idea of a decelerating economy, a decelerating earnings growth, but still positive, that would be consistent with a multiple of the market, somewhere in the 15 or so times multiple range. And that's the expectation. And I would say that's most probable. To the extent that their investor community is pivoting, if you want to use that term as your word of the day, pivoting towards a likely recession, and there would be much greater concern. Market would be trading, in our view, something towards the bottom end, say 3,400 at the end of this year, and ultimately, as you indicate, troughing sometime sort of middle part of next year to trough around 3,150, and that would be consistent, importantly, with the rate market moving a lot lower, and the idea of real rates, which started this year at around negative 1%. A couple of days ago, it was positive 160 basis points, and that pulled back to around positive 130 basis points. So the rate market has been, critical in terms of assessing the level of equities, broadly speaking. But the idea of the end of this year, the next quarter, this quarter, fourth quarter here, we just started, sort of 34 to 3,600 would be the kind of bid-ask range around where we trade, with the idea of the economy slowing, inflation perhaps coming down slightly, and the idea of the earnings slowing as well.
What's the tail risk multiple on the downside for the market, David?
Tail risk, I would say, Guy, would be around 14 times. Would be the, if you want to think about it as a level. That's not necessarily how we kind of arrive at that. We want to think about that in terms of risk premium models, things like that. But answer your question, probably around 14 times, and that's kind of where we'd see it. The market valuation this year has gone from 21 times at the start of the year to around 15 times where we are today.
Yeah. So, David, what kind of profit margin world does that imply?
Well, I think you're setting up the most important development here, which is the big shock to the investment community, both macro and micro, was the CPI reading last month, when the expectation was it would continue to come down, and in fact, it moved the other direction. I think the analog to that in the public equity markets is the third quarter earnings season, which will be coming up, kick off around the 14th of October or so. And the expectations right now are for around plus 4% on the earnings front, year-over-year growth plus 4%. That would be benefiting, if you will, from the energy sector. If you take that away, earnings will be down by around 2%. And coming now to the specifics on the question of margins, the idea of margins declining this quarter is going to be the first time we've seen that in terms of my expectations, and that's likely to continue into next year. Margins will fall next year from around 12.25% this year to maybe 12% next year, and the expectations from the market in terms of the consensus is that margins will expand by around 15 basis points, and that gap of around 40 basis points is the difference between earnings growth of somewhere plus 3 versus plus 7. I think that's the bid-ask debate in the market discussions that I have right now with clients.
David, are you surprised how fully invested the market still is into equities, both retail and institutional?
So the data that we look at, guys, shows something slightly different. We've seen that for the last 31 weeks consecutively that the investor community has been below average, and we want to think about positioning across mutual funds, households, pension funds, institutional investors, retirement funds, showing that that's actually below the average, if you will, somewhat modestly invested. You can think about that in terms of the hedge fund community here. The idea of net leverage has come down by 20 percentage points from like 85 to 65% net leverage. That's actually quite low. The cash positions in equity mutual funds are elevated. So those are all indications of relatively more cautious positioning on the part of most portfolio managers.